Welcome to Breaking News to Trading Moves. I'm your host, and I am glad you're here with us.
Good to be here.
We have a very specific agenda today. We're looking at a single earnings report from a company that, let's be honest, a lot of people in the tech world had sort of written off.
Written off as a relic, yeah, a thing of the past.
Exactly. But the numbers they just put up, well, they tell a very different story. We are talking about IBM.
Mm-hmm. And, the reason we're talking about them today isn't just because they had a good quarter. That happens.
Right.
It's because their report acts as a kind of sorting mechanism for the rest of the market. It gives us a very clear set of criteria to, determine who is winning in this environment and who is losing.
It creates a categorization. That's a great way to put it. If you look at what IBM did right, you can find other companies that look like them.
And on the flip side...
And if you look at what IBM is clearly moving away from, you can find the companies that are likely to struggle. So that's our plan. We're going to break this down into 3 categories of winners and 3 categories of losers, all based on the signals from this one report.
It's a useful framework. Instead of just guessing where the market is going, we can look at the specific mechanics of this trade setup.
Okay, let's start with the headline then. Segment 1. The core event is that IBM beat estimates. Now, beating estimates happens all the time. Companies manage expectations so they can jump over a low bar. But this felt different. Why?
Well, it really comes down to the quality of the beat. That's the key.
The quality.
Yeah. Sometimes a company beats earnings because they cut costs aggressively, or they had a one-time tax benefit, something that doesn't really repeat.
Sure, it helps the bottom line for a quarter, but it doesn't tell you anything about the health of the actual business.
Exactly. In this case, IBM beat estimates because of faster software growth. That's a high-quality driver, it's recurring, it's sticky, and it's what investors want to see.
And that changes the whole narrative, doesn't it? For years, the story on IBM was that they were a hardware company, a mainframe company trying to figure out the cloud.
Struggling to find their footing in a new world.
Right. But this report highlights a new formula. The text we're looking at calls it software-led plus AI monetization plus improving margins.
And that combination is it's potent. It's the hat trick right now.
Let's break that down. Why is that combination so powerful?
Okay, so when you have software leading the charge, your profit margins naturally expand. Software is just a high-margin business compared to, say, hardware or low-end services. You build it once, you sell it 1 million times.
Less overhead, more profit.
Precisely. And then you add AI monetization on top of that, and you have to pay attention to that specific word. Monetization.
Not AI experimentation or AI research?
No. They aren't just experimenting with AI in a lab somewhere. They are making money from it. They are selling it to customers who are paying for it today.
That is a crucial distinction. And I think we'll get to that later when we talk about some of the losers. But there is a big difference between spending money on AI and making money on AI.
A world of difference.
And it seems like IBM has crossed that bridge.
They have. And because they've crossed that bridge, they are changing how investors perceive them. They're moving from that legacy bucket, that dusty old box in the corner.
Yeah, the value trap bucket.
Exactly. They're moving out of that and into a growth and margin bucket. And that brings us right to our first category of winners. If investors like this new profile from IBM, who else fits the description?
Okay, let's do it. Segment 2, winner category 1. This is enterprise software and IT workflow. The logic here, as I see it, is that if IBM is seeing strength in its software sales, it means the broader enterprise market is actually healthy.
That's the top-level signal, correct. There has been a lot of fear, chatter about a recession coming and that companies would slash their IT budgets first thing.
The first thing to get cut.
But IBM's results suggest that isn't happening, at least. At least not for the mission-critical stuff, the things you absolutely need to run your business.
So the market is rewarding 2 things here, according to the analysis: recurring revenue and pricing power.
Yes, those are the 2 pillars of this category.
Let's talk about pricing power. It's a term we hear a lot. It gets thrown around. What does it actually look like in practice for these companies?
It's a great question because it's so important. Pricing power is the ability to raise your prices without losing your customers. Simple as that.
And in an environment where inflation is a concern, or where companies are just trying to protect their own margins, that ability must be like gold.
It is the most valuable trait you can have. Think about it. If you sell something essential, like the core database that runs a global bank, you can go to that bank and say, our fees are going up 5% next year.
And what's the bank going to do?
What can they do? The cost and risk of switching to a new system is astronomical. It would be a multi-year project costing hundreds of millions of dollars. They're not going to do that over a 5% price hike. They'll just pay it. That is pricing power.
That's a fortress. So let's look at the tickers in this category. Obviously, we have IBM, ticker symbol IBM. They're the ones setting the pace here.
They're the primary signal. The whole thesis starts with them.
Then we have Oracle, ticker symbol ORCL. This feels like the perfect example of what you just described.
It is. I mean, Oracle is the definition of sticky. That's the word we use. Their database software is deeply, deeply embedded in the core operations of the largest companies in the world.
It's like the foundation of the building.
It is. You don't just rip out the foundation and replace it over a weekend. It can take years, even a decade, to migrate off of a core Oracle system. That gives them incredible stability and, of course, that pricing power we were just talking about.
So when investors see IBM succeeding with a software-led model, they immediately look around and ask, who else does that?
And Oracle's hand shoots up. They see a very similar story. It's a safe haven in a market that's looking for certainty.
Okay, and the third name here is ServiceNow, ticker symbol NOW. Now, for those who might not follow enterprise software as closely, ServiceNow is a bit different from Oracle. They're more about workflow.
Right? They are. Their business is a little different, but they fit the theme perfectly. ServiceNow started years ago as basically a help desk tool, IT support tickets.
Right, my printer's broken.
Exactly. But they have grown from that into what some people call the platform of platforms for automating work across an entire organization. Human resources, customer service, legal, you name it.
And how do they benefit from the current environment, the one that IBM's report is highlighting?
They benefit in a really specific way. When companies are worried about the economy, when they're worried about margins, what's the first thing they want to do?
Become more efficient?
They want to be more efficient. They want to do more with less. ServiceNow sells the software that allows you to do exactly that. It's a tool for efficiency.
So automation is kind of a deflationary force within a company. It helps them save money.
Absolutely. Think about it. If you can automate your HR onboarding process for new employees, or you can automate how customer service tickets are routed and answered.
You don't need to hire as many people to do that manual work.
You got it. So ServiceNow wins when companies are focused on efficiency and margin improvement, which is exactly the theme that the IBM report brought to the forefront.
So we have safety, we have pricing power, and we have efficiency. That's a strong first bucket of winners.
A very strong bucket.
Now let's move to segment 3, winner category 2. This is where we get into the nuts and bolts of artificial intelligence. We're calling this AI implementation and consulting services.
And this is a really important distinction to make. This is a crucial point for listeners to get. We are not talking about the companies that are building the foundational AI models like an OpenAI.
No, this isn't about the model builders.
This is about the companies that help other businesses actually use those models. The plumbers, the electricians, the people who make it work in the real world.
And the signal from IBM suggests a move from AI pilots to production.
Exactly. Meaning we are done with the science experiment.
The phase of just playing around with it is over.
It's over. For the last year or so, every company has been running a pilot program. Look, we made a chatbot. Look, we generated some marketing copy with an AI.
And that's fine, but it doesn't really move the needle financially. It's a press release.
It's a press release. Production means integrating AI into your core business processes. It means using AI to actually run your supply chain or to do your financial forecasting or to handle your customer support at a massive scale.
And doing that is a lot harder than just signing up for a website and typing in a prompt.
Oh, it's incredibly difficult. The text mentions some specific tasks: integration, data cleanup, security, and change management. I want to spend a second on data cleanup.
It sounds unglamorous. It sounds like janitorial work.
In a way, it is. But it's digital janitorial work, and it is extremely expensive and extremely necessary. Most large companies, their data is a complete mess.
Siloed everywhere.
It's in different formats, it's in different databases, it's duplicated, it's full of errors. If you feed that messy data into a powerful AI, the AI will give you bad answers. It'll just make things up. It'll hallucinate.
Garbage in, garbage out.
The oldest rule in computing: before you can have a smart company, you have to have clean data.
And you can't just press a button to clean it. You need people. You need expertise.
You need armies of experts. You need data engineers and consultants. And that is why the services firms are the winners here. The first ticker mentioned is Accenture. ticker symbol ACN.
Accenture is everywhere. They're a giant.
They are the default partner for the Global 2000. When a CEO of a massive company decides they need to move their AI strategy from a PowerPoint deck to actual reality,
They call Accenture.
they call Accenture. Accenture has been hiring thousands, tens of thousands of data scientists and AI experts specifically for this moment. They are the ones who come in and handle the tricky integration work and the change management.
And change management is huge. That's the human element.
Yeah.
You have to teach the actual employees how to work with the new bots and the new systems.
And every single part of that process is billable hours. That is direct revenue for Accenture.
Okay, that makes sense. The other name in this category is EPAM systems, ticker symbol EPAM. They are a bit more focused on the deep engineering side, aren't they?
They are. If Accenture is the general contractor, EPAM is like the master architect and structural engineer. They are known for very high-end, complex software engineering.
So give me an example. What kind of project would EPAM do?
If you need to build a custom software platform to host your proprietary AI models, or if you need to completely re-architect your cloud infrastructure to handle the massive data loads, EPAM is often the firm you hire for that. They handle the most complex technical integration challenges.
So as companies get more serious about AI, which IBM just proved that they have to spend money with firms like Accenture and EPM just to make it happen.
Precisely. It's what we call a derivative trade. You aren't betting on the AI itself, you're betting on the labor and expertise required to install it. It's a pick and shovel play on the AI gold rush.
I like that. The pick and shovel play. Okay, that covers services. Let's move to segment 4, winner category 3. This is enterprise infrastructure and data center refresh. This takes us back to the hardware.
It does. And while software was the big headline for IBM, we can't ignore this, their infrastructure business, selling servers and mainframes, also showed some real momentum.
And this signals that the long-awaited refresh cycle is finally underway.
It appears so, yes.
Walk us through the refresh cycle. What does that mean and why is it happening now?
Sure. Enterprise hardware doesn't last forever. Servers, storage arrays, networking gear, it all has a lifespan, usually about 3 to 5 years. After that, it gets old, slow, and expensive to maintain.
And for the last year or so, companies have been hesitant to spend money on new gear.
Very hesitant. They were worried about the economy, so they delayed upgrading their equipment. They told their IT departments, look, just make this server last another 6 months, patch it up, keep it running.
They were sweating the assets, trying to get every last drop of value out of them.
Exactly. But you can only do that for so long. Eventually, the equipment gets too old. It becomes a liability. It's slow. It becomes unreliable. It can't run the new modern software you want to use. Or worse, it becomes a security risk.
So IBM's results suggest that we've reached that breaking point. The rubber band is snapped back.
That's the idea. Companies are finally opening their wallets to replace that aging hardware. They have to.
And obviously IBM's a winner here. Ticker symbol IBM. They still sell a lot of big iron, as they say.
They do. The mainframe cycle is a real cash cow for them. It's a very profitable, stable business.
But looking at the broader market, the analysis points to a couple other names. First, Hewlett-Packard Enterprise, ticker symbol H-PE.
Right. HPE is a pure infrastructure play. This is what they do. They sell the servers and the storage that live in the corporate data center. If companies are refreshing their hardware on-premise, HPE is a direct beneficiary. There's no ambiguity there. They are one of the biggest players in that specific space.
And the third name is Dell Technologies, ticker symbol DELL.
Dell is massive in both PCs for consumers and servers for the enterprise. And recently, they've been very, very aggressive with their new AI-optimized servers.
So they're catching two waves at once.
They are. Even if you put the AI part aside for a moment, just the standard need to replace old servers with new, more powerful ones is a huge tailwind for Dell. If IBM is seeing hardware momentum, it is almost a guarantee that Dell and HPE are seeing it too. The tide lifts all those boats.
So if you're looking for winners, you look for sticky software, you look for AI services, and you look for the hardware refresh. That seems like a clear picture.
It is.
Now, let's flip the coin. For every winner, there is usually a loser, or at least someone who is on the wrong side of the current trend. Segment 5, loser category 1. This is legacy IT outsourcing.
And this is the perfect inverse of the IBM story. IBM is winning because they are successfully pivoting away from this exact model.
Right.
They're moving toward high-value software and consulting. And that just shines a bright spotlight on the companies that are still stuck in the lower-value models.
The text describes this as commoditized labor or run the data center work. What does that mean in simple terms?
It means the basic day-to-day maintenance of IT systems. Things like monitoring servers to make sure they're online, resetting passwords for employees, applying routine software patches.
It's essential work, but it's not exactly strategic.
Not at all. And it's a commodity. The word commodity is key here. It means there's no real difference between one provider and another. If I offer to do that work for $50 an hour and you come along and offer to do it for $45,
The customer will choose me every
What?
time. There's no loyalty.
none. There is no pricing power. You are always, always fighting to be the cheapest option. And that absolutely crushes your profit margins. It's a race to the bottom.
So the tickers identified here are DXC Technology, ticker symbol DXC.
DAC has been struggling with this transition for a while now. They have a very large footprint in that traditional labor-heavy outsourcing, and that business is either shrinking or growing very, very slowly.
And as companies move more to the public cloud and automate more tasks with software, the need for these armies of people to just monitor servers goes down.
It goes down every single year, so it's a structural headwind for them.
And the other name is Kyndryl, ticker symbol KDD. Now, this is a bit ironic, isn't it?
It is the ultimate irony. Kyndryl was actually part of IBM until very recently.
Right, they were spun off.
They were. IBM took all of its managed infrastructure services, all the low-margin, labor-intensive stuff we're talking about, bundled it all up, and spun it off into this new company called Kyndryl.
So IBM basically said, we don't want this business anymore because it drags down our metrics and our valuation, and now the market is looking at Kyndryl and saying, yeah, we see why.
That is the dynamic precisely. Now, to be fair, Kyndryl is doing a lot of hard work to fix their contracts and improve their own margins, but structurally, they are in the exact business that IBM wanted to exit.
So in a market that now prizes software plus AI plus margins, Kyndryl stands for labor plus legacy.
It's a very tough position to be in. The narrative is just working against you.
It really highlights how ruthless the market can be in its categorizations. Okay, moving on. Segment 6, loser category 2. This one is high multiple software names.
Yeah, and this is a different kind of loser. It's important to clarify these aren't necessarily bad companies or bad technologies
Well,
or
okay.
just expensive stocks. We are talking purely about valuation here.
Let's explain what high multiple means for someone who might not be familiar with that term.
Sure. It refers to the price you pay for the stock relative to some business metric. Usually it's earnings or it's sales. IBM, for example, trades at a relatively low multiple. It's considered a value stock.
Cheaper relative to its profits.
Right. But many popular software companies, especially in the cloud space, trade at very, very high multiples. And they do that because investors expect them to grow incredibly fast for a long time.
They are priced for perfection.
That's the perfect phrase for it. But the market is currently rotating. We see this all the time. Investors are taking money out of one area and putting it into another. Right now, they're looking for safety, for real cash flow, for margin expansion, all the things IBM just offered.
And they're less willing to pay that huge premium for companies where growth might be slowing down or where the future is just a bit cloudy.
Exactly. The first ticker here is Snowflake. Ticker symbol SNOW.
Snowflake is a fantastic technology company. They really pioneered the concept of the data cloud.
No question about the tech. But their stock has always been expensive. It's always traded at a very high multiple. And recently, there have been some concerns about their consumption-based model slowing down a bit.
So when you combine expensive stock with slowing growth, investors get nervous.
Very nervous. They start to sell Snowflake to buy something that feels safer, like an IBM or an Oracle. The money just moves from one bucket to the other.
And the other name listed here is Zoom Video Communications, ticker symbol ZM.
Zoom. I mean, Zoom was the darling of the pandemic, right? Everyone needed it. Their growth was astronomical.
Unbelievable.
But now they face that classic slowing growth problem. Most people and companies who need Zoom already have it. It's hard to find new avenues for that explosive growth. And unlike a company like, say, Microsoft, which has a dozen different business lines to lean on,
Zoom is very focused. It's video conferencing.
it's very focused. So if that core growth isn't there, the high valuation has to come down to reflect the new reality.
So investors look at IBM and they see a company that's growing and improving margins and paying a
A
dividend.
nice dividend, yeah.
Then they look at Zoom and see a company that's struggling to find its next big act. It's an easy choice for a risk-averse investor. The money flows to the better risk-reward profile.
That is the logic. It is a rotation from risk to quality.
That's a good way to put it.
It's what's happening.
Now, segment 7, loser category 3. This one might surprise some people because we are talking about the absolute giants of the industry, the AI CapEx-heavy mega caps.
Yes, this is a very nuanced point. Let's be very clear. We are not saying these companies are going out of business or that they're bad long-term investments.
Of course not.
But in the specific context of this trade setup, this current market mood, they are under a certain kind of pressure regarding ROI, return on investment.
The contrast here, the analysis says, is between near-term profits and bigger budgets.
Right. Think back to what we said about IBM. They showed that they can invest in AI and improve their profit margins at the same time. They are making money from AI now.
Profitability is visible.
It's visible. The mega caps, on the other hand, are spending absolute fortunes on AI infrastructure, the most advanced chips, building massive new data centers, securing huge amounts of energy for those data centers. But the big payoff from all that spending is still further down the road.
We are talking about billions and billions of dollars in capital expenditure, or CapEx.
Tens of billions. Per company. Per quarter.
The tickers here are Microsoft, ticker symbol MSFT.
Microsoft is leading the AI revolution in many ways through its partnership with OpenAI. But the cost of running that operation, of building out the Azure infrastructure to support it, is astronomical. And investors are starting to ask the hard questions. They're saying, okay, you're spending all this money. When do we see the massive new profits to justify it?
So IBM's report kind of raises the bar for everyone else.
It does. It shows that profitable AI is possible right now. That puts pressure on Microsoft to demonstrate efficiency, not just raw spending power.
And the other name here is Amazon. Ticker symbol AMZN.
Same story, different cloud. Amazon Web Services, AWS, is building massive data centers to support its own AI models and its customers' AI ambitions. But if they report earnings and say, we spent another $15 billion on infrastructure, investors are going to want to see a corresponding jump in high-margin revenue.
And if they don't see it?
If they don't see it, or if the revenue growth doesn't keep pace with the spending growth, the stock gets punished. The market's patience is wearing thin.
So they are losers in this specific narrow context, in the sense that the market is becoming skeptical of their spending until the profits show up.
Exactly. IBM is getting a pat on the back for being efficient and profitable. The mega caps are getting a bit of a side eye for being so expensive.
It's really something how one report from a so-called legacy company can reframe the entire conversation for everyone else.
It's a reminder that no trend lasts forever. The market's mood can change.
So we have our winners and our losers, but the market moves fast. Segment 8, what to watch next? What are the specific things we should be looking for to see if this trend holds up?
There are a few key metrics, both for IBM itself and for the broader sector.
Okay, let's start with IBM.
First, you have to watch IBM's software growth trend. Specifically, look at the numbers for hybrid cloud and automation. Those were the big drivers this quarter. We need to see if that was a one-time blip or if it's a sustainable trend.
So if software growth slows down next quarter, the whole thesis weakens.
It definitely takes a hit, yes. The narrative depends on that software momentum continuing.
And what about on the financial side, beyond just the revenue line?
You have to watch the margin trajectory and the free cash flow. IBM promised margin expansion. They need to deliver it quarter after quarter. And cash flow is the ultimate truth serum in accounting.
You can't fake cash.
You can't fake cash. If they are generating more and more free cash, it means the business is fundamentally healthy and the turnaround is real. If the cash flow falters, then it was just a good story for a quarter.
Okay, that's what to watch for IBM. And what about the broader sector? How do we get confirmation outside of just one company?
We need to listen very carefully to the tone of enterprise IT spending. As other big enterprise vendors report their earnings, companies like Cisco, Salesforce, SAP, you listen to what their CEOs and CFOs say on the conference calls.
What are you listening for?
Are they confirming that customers are still spending on big projects? Are they seeing the same demand for automation and AI that IBM saw? Or are they sounding more cautious? Are they talking about deals taking longer to close?
So if they confirm the positive trend, then the winner categories we discussed, enterprise software, services, hardware, are likely to keep working as trades.
Exactly. It gives you confidence that this isn't just an IBM-specific story, but a broader market theme. But if they come out and say, actually, the market is drying up and customers are scared, then IBM might have just been an outlier.
You need confirmation from the rest of the pack.
You do. Context is everything.
It always is.
Always.
So let's wrap this up. If we were to summarize the whole thing, the core theme here is that the market seems to have a new set of preferences. It isn't just about growth at any cost anymore.
No, that era feels like it's on pause. It's about profitable growth and practical execution. The market loves the fact that IBM is moving AI out of the lab and into production. They love the focus on the unglamorous work, the data cleanup, and the integration.
So they're rewarding the companies that are doing the hard work of making technology valuable rather than just generating hype.
That's a perfect summary. And in turn, they are rotating away from the commoditized, low-margin labor models and the overpriced growth stocks that don't have a clear, immediate path to higher profitability.
It is a flight to quality, a flight to value. And IBM, of all companies, is the one leading the way.
Who would have thought?
It's a great reminder to never completely write off a company just because it's been around for 100 years. Sometimes the old dogs learn the best new tricks.
Or maybe they just know how to survive better than anyone else. They've seen these cycles come and go for decades.
It is a very fair point. Before we sign off, just a quick disclaimer. As a reminder, nothing discussed today is financial advice or a recommendation to buy or sell any securities.
This is purely the opinion of the author and our analysis of the mechanics of the market based on public information.
Always do your own research and consult with a professional.
Please do.
Thanks for listening to Breaking News to Trading Moves. We hope this breakdown helps you see the market a little more clearly. We will catch you next time.